Hi everybody, this is Thomas from Wynn Capital, and I'm going to do a review of the market for the fourth quarter of 2021, and we'll also take a look at the full year. All my contact info is on the screen. If you have questions or comments, connect with me by phone, email, or social media. Let's go to the first slide. This summarizes the fourth quarter of all these different market types or investment types. The U.S. again was the strongest category, up 9% for the fourth quarter. Developed non-U.S. developed countries were up 3. Emerging markets were down a little over 1. China is the biggest component in emerging markets, and it's having trouble. We'll see that in the country index when we get there. Real estate was booming, and the U.S. bond market was up just a little bit. When the bond market's up, it almost always means that interest rates were down. So very little change in interest rates or bond prices in the fourth quarter. This below shows the kind of volatility, the average returns for these assets in the best quarter and the worst quarter. So the next slide looks at a little further. Instead of just a quarter, it's looking at returns for all those same asset classes over the 1 year, 5 year, and 10 year periods. And as we all know, the bull market's been going on for 13 years. We're in the 14th year, I think, of the bull market. If you started at 09, and returns on the 1 year basis and these multi-years, the 5 year and 10 year, those are annualized returns. So if you've been in the market, your equities, U.S. equities going up at this rate, foreign going up at that rate, etc. down the line. And so the 10-year returns for U.S. equities, 16%, which is very, very, it's higher than normal. Let's take a look at something that shows, this graph's a little hard to understand for some people, but it shows rolling returns. And so what we have here is, it shows 2019, and this last bar is 2020. So it's looking back at the last 10 years and aggregating that into a return. The previous bar to that goes back 10 years from there, et cetera, et cetera. So back in 07, 08, 09, we had a long period of poor returns. This was the first year that, like in 08 or so, we had a big decline, and it captured some of the poor performance in the 2000 to 2007. And so we had 3 years of really, really below average rolling returns. Then in 2009, the market reversed, and we built up a couple more years. Pretty soon we had 10 years of good returns, and now we've had 10 years of really fantastic returns. So those annualized returns usually mellow out over time, as this graph shows. It ebbs and flows over time. When these poor 10-year periods happen, it's impossible to predict. But on average, the S&P's gone up about 10% over this long, long period of time, going all the way back to the Depression. So if we go forward and we start to dive into the performance of the world stock market, including the US and all the other countries, just for the fourth period, this shows the quarter, a line graph of price, and down below the news that you'll see on TV, blogs, Facebook, and everywhere. And just because the correlation, since there doesn't mean causation, the news doesn't cause the market to go up and down. It feels like that, but large investors look about 6 to 9 months ahead, and they're pricing it based on what they think will be the case 9 months from now. They're not waiting for the Fed to raise rates. They anticipate that the Fed will raise rates. They anticipate other factors as well, the trends in earnings and every other factor you can think of, and that's what determines today's price, not the news of the day. The news of the day is usually was priced into the market in the past. Of course, there are sudden events that do obviously cause participants to do something in the market. If we look at a longer period instead of a quarter, this graph now is spread out over 1 year. And again, the news that was coincidental to the price. And you can pause and take a look at the news, which is sometimes fun to look back and see where For instance, Bitcoin made its all-time highs. A lot of people jumped on the bandwagon, and who knows how that will be in the future, but they're down about 50% at the moment. So now we're going to dive into each different kind of category, and this is US, and it's the same story that's been the case for a long time, which is large growth stocks like the famous Apple, Microsoft, Netflix, etc., have been doing the best. It is common for the best performing stocks over people jump on the bandwagon, and that works until it doesn't work. So Netflix just fell in one day 24% due to bad earnings report, and these things get overcrowded and overvalued, and they tend to revert to their mean. But large growth remained popular in the fourth quarter, and small cap value was performing less well. Data for longer periods is here on all the categories, and the commentary is over on the left. International developed, again, not as good as the US, but growth did very well. Value and small doing less well. In emerging markets, we have negative returns, which is we'll see in the country index due to China, which is a large part of the emerging markets index, has had all kinds of problems and their stock market's going down. And here we have the country returns. I've highlighted China over here, down what looks like a little over 5%. Some of these other emerging markets having a difficult time as well. And the US is performing well, as we saw. I guess that's Egypt over on the left that had a big bounce. Commodities, now this plays into the inflation. Most commodities are rising in price due to all the factors, supply chain, lack of employees, all kinds of factors. Oil is up, and when oil's up, it takes oil to move all this stuff around. So we have inflation caused by all those factors. Natural gas, I've highlighted a couple times. It's been going up and down huge amounts in the recent past, and energy in general can be extremely volatile. We have negative long-term returns on commodities. I've been around long enough to have really high 10-year returns. Commodities had a big boom during the early years of my practice. And even though we're down in the quarter, the 1-year period shows the inflation of commodities. Even good 3-year period, a little less so on 5-year, but for 10 years, still negative periods. Going to have quite a few more years of positive returns before they get the 10-year positive. This is just the editorial written by DFA, Dimensional Fund Advisors, and they're talking about while the market is high and when valuations get high, you can't anticipate lower returns down the road. You just don't know when it's going to happen. So all through this bull market that started in 2009, clients would come to me in 11, 12, 13, 14. We all thought it was overvalued way back then, but we stuck to our guns believing that you've got to be in the market to capture the returns, and you've got to endure low prices when they happen. You can be lucky or unlucky on the timing of when you have the money to invest or when you apply it. But once you do, you've got to know your risk level, stick to your allocation, diversify properly, manage your taxes, control the things you can control. But the end story of this is that there's good returns after market highs. There will eventually be a market high, and maybe we're at that point now. And again, I don't guess. The market declined, that's all I know. Prices are where they are. I don't know what's going to happen tomorrow. To me, it's a 50-50 chance that we'll bounce back to new highs. Recency bias will make most of us think that the down market will continue because we just believe that whatever happened yesterday will happen tomorrow. But in general, this means that you can invest at market highs and you'll still do okay. This is my contact info again. And if you need to have any questions or you want to talk about things, you're welcome to give me a call anytime. I hope you found this helpful, and I'll talk to you all soon. Bye-bye.